I'm Dan Vredeveld, Senior Advisor with Richmond Brothers, and I'm here today to provide our community with some general education about the Secure Act 2.0. While the Secure Act 2.0 was enacted on December 29, 2022, the effects and changes of Secure 2.0 continue to roll on. 2024 brings a wave of changes and little-known tax planning opportunities. In fact, there are about 10 changes that become effective in the year 2024. Let's briefly go through them so you know what to expect. Please note that it is possible that additional guidance, including regulations, will be provided over time from the IRS. So first of all, IRA catch-up contributions have been indexed for inflation. So for 2024, the annual maximum IRA contribution is $7,000 per individual. If you're age 50 or better, you can include $1,000 extra catch-up contribution, which would allow you to max out at $8,000 per individual. This is a $500 increase from 2023. Now please note that in the past, catch-up contribution levels for IRAs did not change, but Secure 2.0, they'll be indexed to inflation beginning in 2024, meaning it could increase every year based on federally determined cost of living increases. All right, number 2, QCD, that's a qualified charitable distribution, has a $100,000 limit increased for inflation. In 2024, individuals who are 70 and a half years or older may use a QCD to donate up to $105,000 to a qualified charity of their choice, as long as it's directly from their IRA. This change from the initial $100,000 QCD limit set for tax year 2023 reflects Section 307, which indicated the limit will be annually indexed for inflation. All right, number 3. Matching plan contributions can be made on student loan payments. The Secure Act 2.0 provides the ability for employers to match workers' student loan payments with a contribution to their 401k, 403b, or other retirement accounts. This will help those who are missing out on available employer matching because they are prioritizing paying off their student debt instead. Number 4. 10% penalty exceptions. Let's say you're facing a serious cash shortfall. One possible solution is to take an early withdrawal from your traditional IRA, SEP IRA, simple IRA, things of that nature. Unless an exception applies, there will be a 10% early withdrawal penalty tax on the taxable portion of a traditional IRA if you're under 59 and a half. Historically, there have been more than a dozen ways to sidestep the extra charge. In 2024, the Secure 2.0 law adds 3 new exceptions to their list. So the first exception is emergency expenses. So for plans and IRAs, $1,000 a year, the first is they allow for $1,000 a year, which is defined as unforeseeable or immediate financial needs relating to personal or family emergencies. However, this exception is extremely limited. Yes, if a person faces an unforeseeable personal expense or immediate financial needs relating to a personal or family emergency, they may dip into savings. Yes, the account owner can self-certify that the emergency is real. There is no need for an independent financial analysis. But the dollar amount is limited. Like I said, $1,000 is permitted per year. The taxpayer has the option to repay it within 3 years. This provision is effective for distributions made after December 31st of 2023. All right, the second one, defined contribution retirement plans would be able to add an emergency savings account that is designated Roth account eligible to accept participating contributions for non-highly compensated employees starting in 2024. Contributions would be limited to $2,500 annually or lower as set by the employer. And the first 4 withdrawals in a year would be tax and penalty free, depending on plan rules. And contributions may be eligible for an employer match. In addition to giving participants penalty-free access to funds, an emergency savings fund could encourage plan participants to save for short-term and unexpected expenses. All right. Lastly, and sadly, domestic abuse is a common enough occurrence that it was included as a 10% penalty exception. Effective in 2024, a new exception is created for victims of domestic abuse that occurred within the previous 12 months by a spouse or domestic partner. Those in need of leveraging this exception can self-certify that they experienced domestic abuse and withdraw the lesser of $10,000 indexed for inflation or 50% of the balance of the account. Distributions taken under the domestic abuse exception can be repaid to the same or another like account over 3 years, and income taxes on repaid dollars will be refunded. All right, higher simple plan limits for deferrals and catch-ups and non-elective contributions. For eligible employers with 25 or fewer eligible employees, the employee's simple IRA elective deferral limit for 2024 is $16,000. However, with a recent provision, the limit becomes $17,600, and the catch-up deferral of $3,500 becomes $3,850. Employers are allowed to make an additional non-elective contribution for years beginning after 2023. This additional contribution can be up to 10% of compensation, but not more than $5,000 per employee. All right, number 6, 529 to Roth IRA rollovers, $35,000 lifetime income. While 529s can be a great tool for some, there have been some downsides to that. If they decide they won't be attending school or they end up getting financial aid and don't need all of the money. Starting in 2024, you'll be able to convert tax and penalty free up to a lifetime limit of $35,000 in a 529 to a Roth IRA owned account by the 529 beneficiary for at least 15 years, subject to annual Roth IRA contribution limits. It is worth noting that the annual contribution limit and income limits used would be the beneficiaries, not the parents, not the conversion, and only the conversion apply only to Roth IRAs and not traditional IRAs. All right, 7th change, no lifetime RMDs on Roth accounts. Thanks to Secure Act 2.0 for 2024 and beyond, required minimum distributions will no longer be required from designated Roth accounts in employer-sponsored plans. Roth IRAs set up in your name that have been open for at least 5 years are exempt from the RMD rules during your lifetime, allowing your account to accumulate money to pass down to your heirs. But if you inherit a Roth IRA, the RMD rules do still come into play. All right, number 8, surviving spouse may elect to be treated as a deceased spouse. Secure 2.0 has added options for surviving spouse beneficiaries to be treated as a deceased spouse when inheriting IRAs from their late spouse. This option allows the surviving spouse to use the more advantageous uniform lifetime table to calculate the required minimum distributions from the deceased spouse's IRA. The new rules could be particularly beneficial if the younger spouse dies first or the surviving spouse remarries. This could reduce the level of RMD significantly for the surviving spouse. Number 9. This last one we want to know isn't a change so much as for this year, but it was originally slated to occur in 2024. But for those aged 50 or older, Secure 2.0 says plan catch-up contributions must go into a Roth account if your wages are greater than $145,000, and that'll be indexed, so the numbers will be going up beyond 2024 in the prior year. That was supposed to happen this year in 2024, but the IRS delayed that provision into 2026. So, if you're in that position and you still want to put your catch-up contributions in your traditional 401k, you can still do that. Let's say, for example, you make $200,000 a year. If you contribute 20 grand to your 401k, you're only taxed on the 180,000, which is the net amount. And you can do this for 24 and 25 still, if that makes sense for your situation. For a quick snapshot of changes impacting your retirement accounts that have recently gone into effect, make sure to download the Secure 2.0 effective dates from Slott and Company below in this video now. I hope you found this to be helpful, but please make sure to consult with your own tax and legal advisors before making any action that can have tax consequences. Thank you, and make it a great day.